Yes guys, so let's discuss AS 19. Accounting for lease. Again talking about the applicability. All enterprises. However, there are few exclusions from the scope of the standard. Three leases do not form part of AS 19 at all. There are three particular leases which we have excluded from the scope of the standard. The first one is lease of land. An open piece of land leased out cannot be considered as part of AS 19. Lease of motion picture rights. Videos, audio scripts, etc. These are excluded from the scope of the standard. And the last one, lease for extraction and exploration of mineral rights. There are separate guidance notes issued for the second and the third. Motion picture rights, videos and audio scripts is a new part that we have come up very recently, and your lease for extraction and exploration of mineral rights has always been covered as per a guidance note, has never been covered under any particular standard. Any particular standard will have this exclusion of mineral rights. These are the exclusions from the scope. First, let's understand what is this term lease. What do you understand by the term lease? Lease stands for lease is an agreement or a contract to use the asset for a periodic lease payments. A simple dictionary meaning which we can take. It is a contract to use the asset acquired by a person in consideration of a periodic lease payments. So when I'm talking about two persons, X and Y, X transfers to Y right to use an asset. Like we always know, in a contract there is a consideration which should be paid in return, and this consideration which is paid in return is called as periodic lease payments. So basically X is transferring a right to use his asset to Y, and Y will give him an consideration, some periodic lease payments. Here I'll call X as a lessor and Y as a lessee. If you talk about the ownership of the asset is always with the lessor. But lessee has a possession of the asset since he is using the asset in consideration of periodic lease payments. X is the owner of the asset while Y is having the possession of the asset. This is how we can define a simple lease agreement. A person is actually transferring a right to use the asset to another person and receives a periodic lease payment in consideration. The person who is the owner of the asset who is giving the right is called as a lessor. A person who acquired such right is called as a lessee. Now, this is a simple understanding of your lease. Now let's get into what is this AS 19 talking about. According to AS 19, the first part should be classification of lease. To understand the accounting, we need to first classify the lease. How do we classify a lease? He says a lease can be classified into two types. First one is called as a finance lease, and second one is an operating lease. Now, how do we differentiate between a finance lease and an operating lease? Let's understand by simple definition. Finance lease is a lease agreement which transfers substantial risk and rewards incidental to ownership of leased asset to the lessee. There's a transfer of substantial risk and rewards incidental to the ownership of the leased asset to the lessee. In such cases, I'll call it as finance lease. These terms, substantial risk and rewards incidental to ownership being transferred, these terms are also used in AS 9, where you are talking about revenue recognition on sale of a good. If I want to sell a good, and at what time should I recognize the revenue? He says, I'll recognize revenue when substantial risk and rewards incidental to the ownership of the good is transferred to the buyer. Now, similar terms are being used here. I'm saying that in a finance lease, I'm transferring the substantial risk and rewards. Let's say we have acquired a car on finance lease. In such cases, whatever damage the car has suffered in your hands will be at your cost. You cannot transfer that risk to the owner of the asset. Even though you are not the owner, you are a deemed owner when it comes to the damages. So that is what he's talking about, substantial risk and rewards. Now, substantial in the sense, almost everything. Almost every risk and reward is transferred of the leased asset to the lessee. While operating lease can be simply put as other than finance lease. Other than a finance lease can be called as operating lease, or in a simple sense, if you want to try to understand, where substantial risk and rewards are not transferred to the lessee, I can call that as an operating lease. Now, when looking at this definition, it would be difficult if I give you a lease agreement to identify if it is a finance lease or an operating lease. Because this is just saying that substantial risk and rewards incidental to the ownership of the leased asset is transferred to the lessee. But when do I say that the substantial risk and rewards are transferred to the lessee? There should be particular situations on satisfaction of which I can say that it is satisfying the condition of substantial risk and rewards being transferred. For this purpose, he has given us a few conditions which are not saying that they are not exhaustive conditions, but they are inclusive conditions. He says, if these following conditions are satisfied, you can call it as a finance lease. However, there could be some additional conditions according to the case, but as of the standard is concerned, let's see how do we classify indicators of finance lease. There are no indicators of operating lease, guys. If it does not satisfy the conditions of a finance lease, then it should automatically be operating lease. What are the indicators of a finance lease? In total, we have 5 indicators. The first one, lease transfers. Ownership of leased asset. To lessee at the end of lease term. The lease transfers ownership of leased asset to the lessee at the end of lease term. In simple sense, there's a lessor who's transferring the asset to the lessee, and the lessee is paying a periodic lease rental. At the payment of the lease at the end of the lease term, after paying the last lease rental, he's saying that the lease automatically transfers the leased asset to the lessee. Now, if you observe, this is very similar to what we have seen in hire purchase. All your hire purchase agreements will satisfy the condition of finance lease. Same thing happens in even hire purchase. When an asset is purchased on hire purchase, they are paying some periodic installments. At the end of the last installment, the asset will be transferred to the buyer now. Same thing is happening here. The lessee is paying periodic lease rentals, and on payment of the last lease rental at the end of the lease term, the leased asset will become the owner, the lessee will become the owner of the leased asset there. So very similar to hire purchase agreement what we have seen. The second condition is the most critical of all. Lessee has an option to acquire the leased asset at the end of lease term. That is just the start of the point, guys. Understand this till here. The lessee, the lease is not directly transferring to the lessee at the end of the lease agreement. He's saying that at the end of the lease agreement, the lease is giving lessee an option to acquire the leased asset. So at the end of the lease term, the lessee can take the option of buying the leased asset. However, he is saying that additionally, at a price which is sufficiently lower than its fair value when the option becomes exercisable. This I can call it as an additional condition. So, in the second point, the first part we have seen, the lessee has an option to acquire the leased asset at the end of the lease term. The lease as such is not transferring it to the lessee, but the lessee can buy the leased asset at the end of the lease term. But he's saying that the price at which he can purchase the leased asset according to the lease is sufficiently lower than its fair value. Sufficiently lower than the fair value. When is the fair value being considered? I can't consider at the beginning of the lease. I should consider it when the option becomes exercisable. When is the option becoming exercisable? At the end of the lease term. So at the end of the lease term, whatever is the fair value of the leased asset, the price at which he can purchase the leased asset should be sufficiently lower. Sufficiently lower in the sense there is no particular measure to that. Sufficiently lower can be taken as even 40%, 30% or 50% of the fair value as well. So there is no particular measure to tell you what is sufficiently lower here. He doesn't stop here. whenever he sees this word option of lessee, whenever the standard talks about option of a lessee, always he drops in with an additional condition saying that it is reasonable at the inception of lease that the lessee will exercise the option. That the lessee will exercise when at the inception of the lease itself. That means at the beginning of the lease itself, it is reasonably certain. It is reasonably certain. Let's use the word reasonably certain. It is reasonably certain at the inception of the lease that the lessee will exercise the option. That means at the beginning of the lease term itself, when he is entering into the lease agreement itself, I am very sure that he will be exercising the option to acquire the leased asset. In that situation, can there be a situation where I am offering an asset at significantly lower than fair value, but still the option will not be exercised? Possible. Completely possible. You might think that anyways he is offering it less than fair value. What is the point? He can definitely go and buy the leased asset. At the end of the lease term, when someone is giving you a 100 rupee item for 50 rupees or 40 rupees, what is the harm in even exercising the option? Why should I even come down to this one saying that it is reasonably certain at the beginning of the lease agreement? Let's take a transport service. Let's say there was a travel agent, XYZ Travels, who was running some tour services from between two cities. Now let's say if I'm considering such a person, if he's taking a lease of a particular asset, that is a bus, at the end of the lease term, let's say the lease term was about 3 years. After 3 years, he is not interested to take over the vehicle, even though it is offered for a cheaper price. Reason is, after 3 years, it is not giving the same comfort what he wants to give to the passengers. Because after 3 years, automatically the bus is older. There is a lot of noise which is done, or even the seats are not proper. He does not want to renovate the entire thing. His entire reputation is at stake, so he would definitely not want the option to be considered. He wants to give away the asset and he wants to take a new asset on lease. He would not consider this option at all, because this is of no use for his business. There is no point for him to acquire the leased asset at a price which is significantly lower. Got it? So there could be situations where even though the asset is offered for a lower amount than its fair value, still the option may not be exercised. Got it? Normally whenever you talk about any corporates also, no corporate is really interested to own any vehicle. So they basically are more comfortable with leasing out the vehicle. At the end of the lease term, they'll say, even though it is for a cheaper price, I don't want the asset. You keep the asset with yourself, I'll go for a new asset now. So this is a normal agreement what you normally see. Now this is the second condition. So on the second condition, I can break it into 3 parts. First one, there's an option for the lessee to acquire the leased asset at the end of the lease term. Additional condition, at a price which is sufficiently lower than the fair value when the option becomes exercisable. One more additional condition, it is reasonably certain at the inception of the lease that the option will be exercised. So this is your second point. The third one, lease term covers majority of economic life of asset. What is majority? Majority is greater than 50%. That is what we normally call as majority. Majority is anything more than 50%. Lease term covers majority of economic life of the asset. Now first of all, to understand this point, we have to differentiate between what is economic life And what is useful life of an asset? There is no other life of an asset except economic life and useful life. There is no commercial life, production life. All those words are not there in accounting. Accounting, we have only two lives. What is an economic life of an asset? What is a useful life of an asset? Economic life of an asset, this term you will see only in AS 19 and AS 28 impairment of assets. There are only two places where we use this word economic life. Otherwise, normally, whatever we use is useful life. If you remember depreciation also, AS 6, very clearly he says, cost minus estimated residual value divided by estimated useful life of the asset. It is not economic life of the asset. So there you stress about useful life, not economic life. AS 26, intangible assets also talk about amortization over useful life of the intangible asset, not the economic life at all. Useful life word is used plenty of places. Wherever it comes to amortization, depreciations, everything is as per useful life of the asset. Then what is the difference between economic life and useful life? Let's say for example, there's a car. I own a car and I have an intention to use this car for 3 years or until it reaches some 50,000 or 60,000 kilometers. After that, I have no interest in continuing to use the car. So I am interested to sell the asset. So when let's say we have put it up on OLX or whatever quicker you want, and there's someone else, let's say Mr. X purchased the asset now. Mr. X purchased the asset from me and he wanted to use the asset for 2 more years. Let's say he also completed using the asset. After 2 years, Mr. X again put it on OLX or quicker and he sold it to Mr. Y. Mr. Y used it for 1 more year. I don't think so. After that, there is any useful life which is left out in the asset because already the asset has been used by me for 3 years, 2 years there, and Y used it for 1 year. 6 years is already over. And I'll say that the asset is useless or it cannot be economically used. What is the meaning economically used? Economical usage. Whenever I'm talking about economic usage, then I'll say that the benefit derived in use on use is greater than the cost incurred on use. When the benefit derived on use of the asset is greater than the cost incurred on use of the asset, then I will say it is economic usage. So in the given example, I used it for 3 years, X used it for 2 years, Y used it for 1 year. I will say that the economic life of the asset is 3 plus 2 plus 1, 6 years. That is the economic life of the asset. Then what is the useful life? Useful life is never seen from the asset perspective. Useful life is always from the perspective of the user. That means, I was using the asset. What was my useful life? My intention was to use the asset for 3 years. So my useful life is 3. Mr. X has a useful life of 2. Mr. Y has a useful life of 1 year. So useful life is never from the perspective of the asset. It is from the perspective of the user. How many years the user wants to use the asset, that is useful life. How many years the asset can be used is the economic life. Period for which the user is expected to use the asset. Can I put up a simple formula saying that I can never have an economic life greater than or equal to useful life. I can never have a useful life which is greater than economic life. Either your useful life is equal to economic life or your useful life is lower than economic life. So I can never have any situation where the useful life is greater than economic life. Economic life is always greater than or equal to useful life. Let's say I have used the car for the entire 6 years. After 6 years the car cannot be used. My useful life was 6 years, the economic life of the car was also 6 years. So in such situation you will observe that the economic life is equal to the useful life, or else normally we see that useful life is always less than economic life. Life of an asset can be expressed either in years or in the number of hours in the case of machine, or number of production units in the case of machine. Your life can be expressed in any possible way. In the case of a car also, normally we can express it in the number of kilometers run as well. So lease term covers majority of economic life, not the useful life. So more than 50% it should cover. Fourth one. This is something very typical, guys. Minimum lease payments. This word is being used here. The minimum lease payments discounted to their present value are substantially equal to fair value of leased asset at inception of lease. Minimum lease payments, the present value of the minimum lease payments are substantially equal to the fair value of the leased asset at the inception of lease. Yes, the question will be, what is this minimum lease payments? We'll come to that later on. We have one more thing which we are supposed to check. What is the meaning of this term, lease term? What is the meaning of inception of lease? Inception is the beginning, I know, but there is some elaborate definition which is given as per the standard. Lease term, inception of lease, minimum lease payments, these are few words which we have to discuss. I'll come back to the fourth point, guys. Let's complete this indicators first. Fifth one, leased asset is of a specialized nature. Leased asset is of a specialized nature that only the lessee can use the asset without major modifications. Leased asset is of a specialized nature that only the lessee can use the asset without major modifications. And normally if it is a customized asset, according to the lessee's requirements, the customized asset cannot be used by anyone else without major modifications, obviously. Let's say there was an ATM which was set up on a moving vehicle, okay, and they wanted to, put it at any particular place in a parking lot, anyone can come and withdraw it. This was a leased asset. Now, when the lessor gave it on lease to the bank, he has actually customized a truck and an ATM machine on that. Now, can it be used by someone else? In no way I can use it. Now, it can either be used by any other bank or by anyone else if you want to use. I want to pull the ATM machine from that, use it as a truck separately. So, without major modifications in the asset, I cannot use the asset. So, in such cases, I'll call it as a finance lease. Now, let's try to understand the basic terminology used here. Lease terms, inceptions, minimum lease payments. Now, what are these terms and how do we try to identify these items. But before that, when we started with classification of lease, I said lease can be classified either into a finance lease or an operating lease. Now there are 5 indicators of finance lease which I have given, and I said these are not an exhaustive list. They are just inclusive list. So if these conditions are existing in a lease agreement, it can be called as a finance lease. Any other condition in any lease agreement might also indicate it towards a finance lease. I am not restricting the conditions at all. These are given in AS 19, that's it. So in a practical scenario, when we are talking about a new lease agreements, when they come up to you for the purpose of classification, every lease agreement should be dealt in case to case basis. Got it? One very important conclusion in classification of lease is that lease can be classified only on inception of lease. The lease can be classified only on inception of lease. That means it can be classified either as finance lease or an operating lease only at the beginning of the lease agreement. Let's say, for suppose, the lease agreement initially drafted was suggesting it to be a finance lease. You classified it as a finance lease. After 1 year, even though the lease term has not expired, the lessee and the lessor mutually agreed to make some adjustments or some amendments to the lease agreement. And after such amendments being done in the lease agreement is now being classified as an operating lease and cannot be classified as a finance lease. Can I reclassify that way? Now the problem basically happens whenever there's a changes in the lease agreement as such. When the changes have actually forced you to reclassify from finance lease to operating lease or operating lease to finance lease, that is not allowed in AS 19. AS 19 only says lease can be classified at the inception of the lease. Then if there is a situation which arises where there are changes in lease agreement which actually force you to reclassify a lease, in such situation, I'll consider that the first lease agreement, the original lease agreement was cancelled, and the amended lease agreement will be treated as new lease agreement and will be classified again. Got it? When the conditions, or you can also call it as terms of lease agreement are modified in such a way that it requires reclassification, reclassification, the amended lease agreement will be treated as a separate lease agreement. And classified accordingly. The original lease agreement stands cancelled. or can be treated as null. Hence, I can conclude saying that there is no reclassification of lease. There can never be a situation of reclassification of leases. Yes guys, there were few terms which we are supposed to understand: lease terms, inception of leases and minimum lease payment. So let's check that first. First, let's talk about inception of lease. To understand this inception of lease, let's first understand, is it necessary for a lease agreement to be always reduced into writing? Not necessary. A lease agreement, a lease can be either oral or written. Now, this will require some understanding for you to get what is the inception of lease. If it is oral, then I don't have any lease agreement as such. The lease agreement, the conditions of the leases are negotiated only orally. But a written lease agreement, I have a documented proof saying that this is the term, this is the date on which I have started the lease. So, inception of lease is earlier of first one, date of lease agreement. Or the date on which the principal conditions of lease are agreed upon. What are principal conditions? What do they mean? Principal conditions are the main conditions of a lease. So what are the main conditions of a lease? What is the lease term? What are the periodic lease payments? And how does the lessor accept the lessee to use their asset? Now I can't have my leased asset being the ownership. I am the owner of the leased asset. I can't have my leased asset being used in any manner the lessee wants. A lessor has to prescribe saying that the leased asset cannot be used in these particular manners. That will also form part of your principal conditions. The principal conditions are the main conditions: lease term, lease payments, all these are principal conditions of a lease. Date of lease agreement is not applicable for oral agreements. Oral agreements, I'll directly take the date on which the principal conditions of lease are agreed upon. But for a written agreement, I can have both. I have a date of lease agreement, also a date on which principal conditions of a lease are agreed upon. Then what do you understand by this term? Lease term. Lease term is duration of lease. In simple sense to put up, it is a duration of lease. So how long does the lessee acquire the right from the lessor to use the leased asset? That in simple words is put as lease term. It is not so simple, because he says that lease term is a non-cancelable period for which the lessor grants a right to the lessee to use the asset. If he stops here, then the condition is very, very simple. But he'll say additional condition is putting up like this: if the lease can be extended at the option of the lessee, then even that extended period should be included as a lease term. So that means, let's say the lease was initially written for 3 years, giving an option to the lessee to extend the lease for 2 more years. And if in such situation, whenever there is an option of the lessee, I told you whenever there is an option of a lessee, I have an additional condition. It is reasonably certain at the inception of the lease that the lessee will exercise that particular option. In the same way, if that renewal option for 2 more years, if it is reasonably certain that the lessee will exercise, then the lease term is not 3 years. 3 years plus those 2 additional years, total 5 years will be your lease term. So lease term is non-cancellable period for which lessee acquires the leased asset from lessor here comes the word together with that means additionally add it with additional period for which the lease can be extended with or without any further payment at the option of lessee. I told you whenever this condition comes up, option of lessee, I need to take up the last condition. And it is reasonably certain. And it is reasonably certain. Just copy paste whatever is there. It is reasonably certain at the inception of lease that the lessee will exercise the option. It is reasonably certain at the inception of lease that the lessee will exercise the option. So lease period is a non-cancellable period for which the lessee acquires a right to use the leased asset from the lessor. Together with means plus additional period for which the lease can be extended with or without any further payment. With or without any further payment at the option of lessee. Whenever we see this word option of lessee, we have already seen the additional condition. It is reasonably certain at the inception of the lease that the lessee will exercise the option. This will give me an understanding of what the lease term is all about. Other than this, we also had one typical term which we use in point number 4. That was minimum lease payments. In short, we call it as MLP. Minimum lease payments. Now what do we understand by this minimum lease payment? Who makes the lease payment? Lease payment is made by lessee to the lessor. So what I'll see, minimum lease payment I'll have from the standpoint of lessee and also from the standpoint of lessor. if you observe logically, what the lessor should receive is what the lessee pays. So, in simpler words, I can say that the MLP for the lessee, what the lessee pays, should be equal to the MLP that the lessor receives. Then why do I have to split between both? Why do I have an MLP from the standpoint of lessee and a standpoint of lessor separately? In simple sense, whatever the lease payments are made by the lessee will be received by the lessor. There ends the matter. So both should be equal. Both are not equal. There's a small additional consideration what the lessor gets, which the lessee does not pay. Then who pays? Someone else pays. We'll come to that condition, but check this. What is the minimum payment that the lessee makes? Minimum, bare minimum, this is the payment that should be made. Under a lease agreement, they have agreed to some lease payments. So that lease payment should be done periodically. So, lessee will pay lease payments over the lease term. Monthly, half yearly, quarterly, annually, whatever it is, my lease payments will be made over the lease term. This is a compulsory payment. Plus, in addition to that, sometimes the lessee is acquiring the leased asset towards the end of the lease. So that also should be paid. So this is called as guaranteed residual value. By lessee. What is this guaranteed residual value? Residual value is the value of the leased asset at the end of the lease term. Now, that portion of residual value which is guaranteed by the lessee is called as guaranteed residual value. Now, understand guys, whenever a guarantee is given by the lessee is also supposed to make the payment towards the end of the lease term. So, what is he paying? He is paying lease payment over the lease term. Yes guys, what the lessee pays is whatever is the lease payments over the lease term plus a guaranteed residual value. The residual value is the amount which he is supposed to pay towards the end of the lease term. Now understand, whatever the lessee pays, who will receive? Lessor should receive. So I can say that from the standpoint of lessor also this should be lease payments over lease term plus guaranteed residual value by lessee. Then what is the difference? It doesn't make sense in writing both separately because in sense basically both are the same. I said there's an additional point which will come to the lessor. Is it necessary that the lessee should always take over the leased asset? Not at all necessary. Sometimes there can be a situation where the lessee will not guarantee anything. The lessee will use the leased asset for a lease term and at the end of the lease term he will give it back to the lessor, saying that I do not want to use the leased asset anymore. Now what will happen to the lessor? The lessor will try to take the guarantee. If it is not from the lessee, then I will try to take a guarantee from someone else. Now who is this someone else? Thinking from the lease, then in the lease there are two parties, lessee, lessor. But now the lessor is saying, since I do not have a guarantee from the lessee that he will be taking over the asset at the end of the lease term, I will try to seek the same guarantee from someone else. Now this someone else, guaranteed residual value by the lessee, or if the lessee does not give, then I will take it from third party. That is a receivable for the lessor, but it is not payable of the lessee. Lessee is not giving the guarantee. Who gave? Some other fellow gave the guarantee. Now is it possible to have this? Like we have already seen the example of a travel agent, someone who is running, some buses on travel between two cities. Then let's say he has taken a Volvo bus for 3 years. At the end of 3 years, what does the travel fellow say? I don't want to use the asset anymore. I want to take a lease of a new asset now. Now, what does the owner of the leased asset do? Leased asset, he can't start his own travels now. He has no intention to do that. He is the owner of the leased asset. Now, in what way can he use the leased asset? He can't use it for his own private transport. So the easier method what he'll try to do is, at the end of the lease term, he will try to sell the bus to someone else. Now, who could be this someone else? He could sell it to some corporates, because the corporates are also running vehicles on, for the transport of their employees. Or the easier one is to colleges and schools, because people do not come to college and school to see how the bus is, but basically to learn something from there. So even if the bus makes some sound, it doesn't really matter for the person who is sitting in the bus. So normally they could get a guarantee from someone else. That could be a school or a college or someone else. Those people are called as a third party to the lease contract. Got it? So either the guarantee can be from a lessee, but if the lessee does not give a guarantee, then the lessor will try to seek the guarantee from someone else, which is a third party. Now, to basically understand a guarantee, let's say we have written an exam. In the exam, if someone will ask us, how did the exam go? Our first reaction will be like, amazing. He'll ask again the same question, how did your exam go? Extraordinary. But when it comes to how many marks can you score? 80 plus? 80 plus, I'm not really sure. 70 plus, I'm not sure. 60 plus, I'm seriously not sure. Okay, 50 plus. I'm like, okay, I'm confident. 50 plus I'll get. Then give it to me in writing that you will get 50 plus. If you won't get 50 plus, then there will be some, penalty which I'll levy on you. In that case, will I write 50 plus? Even 50 plus also I'm doubtful now. I'll try to write something as 40 plus or 35 plus. Now, simple logical reason here is, whenever someone wants to give a guarantee will never be given for fair value. It can never be for fair value. It is always lower than fair value. When someone is asking you to give a guarantee, I cannot give a guarantee for the fair value. My guarantee amount will always be lower than the fair value. In the same way, someone who is guaranteeing the residual value. What is the residual value? Residual value is the fair value of the asset at the end of the lease term. Then what is guaranteed residual value? What is the amount guaranteed? That means always the fair value is greater than the amount of the guarantee received. So in simpler sense, I can put it this way. In simple words, I can say that my residual value is always greater than guaranteed residual value. This in short we call it as GRV. This is in short RV. Residual value is fair value of leased asset at the end of lease term. Guaranteed residual value is a portion of residual value guaranteed by, who is guaranteeing? Either lessee guarantees or some fellow third party will guarantee. That portion of residual value which is guaranteed by lessee or a third party. I have an equation. To make it as an equation, I'll write it as RV is equal to GRV plus something. If I add something to the GRV, then I'll get RV. The something here, I'll call it as UGRV. There is guaranteed residual value, so UGRV is unguaranteed residual value. This is unguaranteed residual value. Now guys, we haven't started the accounting for leases yet. We are only seeing the definitions of the entire words. In the similar way, there are few other definitions which we need to understand before we go into the accounting for it. The first such statement, what we have to understand, is called as GIL. This is also called as gross investment in lease. Who is the person who invested in the lease? The person who has put up some money into the lease is a lessor, because he should acquire the leased asset. The lessee is only making periodic lease payments, so it is not his investment. So gross investment in lease, when I calculate, it is always for lessor. So GIL always for the lessor, and my GIL can be given as lease rental over lease term plus residual value. Residual value is a combination of both GRV as well as RV. Actually, the formula can be also written as minimum lease payments from the standpoint of lessor plus UGRV. Check, it will give you the same thing. Check, it should give you the same thing. What is minimum lease payment from the standpoint of lessor? Minimum lease payment from the standpoint of lessor is lease payment over the lease term plus guaranteed residual value by lessee or the third party plus UGRV. That means GRV plus UGRV can be also written as RV. We have already seen this. GRV plus UGRV is RV. So I can bring it as RV. I can write it as lease rental over the lease term plus the residual value. Or it can also be written as minimum lease payments over the standpoint of the lessor plus the unguaranteed residual value. The next one is called as UFI. Unearned financial income. The formula is UFI is equal to unearned financial income is equal to GIL minus present value of GIL. Gross investment in lease minus the present value of gross investment in lease. Then come to NIL, that is net investment in lease. NIL can be given as GIL minus unearned financial income. Substitute in check. GIL minus, what is unearned financial income? Gross investment in lease minus present value of gross investment in lease minus GIL plus present value of GIL. This GIL gets cancelled. So NIL can be given as present value of GIL. I can simply say net investment in lease is the present value of gross investment in lease. Instead of calling it as GIL minus unearned financial income, I can simply say it is present value of gross investment in lease. These are three formulas which we need: GIL, unearned financial income, and net investment in lease. Whenever we are talking about present value, how do we get present value? Present value always is through a discount rate. You need a discount rate to identify the present value. That means even wherever we have been using present value, we need to know what is the discount rate being applicable here. So what I can say is the discount rate is different for both lessor as well as for the lessee. Lessor's discount rate is called as interest rate implicit from lease. Or in simple sense, it is a valuation of IRR. A simple calculation of IRR. While for a lessee, it is called as incremental borrowing rate. How do you get this interest rate implicit from lease? Interest rate implicit from lease can be given this way. The discount rate at which the present value of gross investment in lease is equal to fair value of leased asset. Then what is this incremental borrowing rate? Incremental borrowing rate is a rate at which the lessee can borrow funds to acquire the leased asset instead of opting for lease. So instead of going for leasing of the asset, if the lessee wants to buy the leased asset, and at what rate he can borrow funds will be incremental borrowing rate. The rate at which lessee can borrow funds to purchase the leased asset instead of going for a lease is called as incremental borrowing rate. These rates will be given in the question. These rates will be given in the question. It is only for your understanding as to what is required to be a discount rate. So this is sufficient for us to understand the accounting for leases. Now, we haven't come to the accounting yet. This was the basic introduction part. Let's get into the accounting for leases. How many types of accounting can you see? I have 2 leases, finance lease, operating lease. Plus, I have 2 persons as well who are involved. So, I need to see it in the books of lessee, also in the books of lessor. So totally I need 4 recognition and measurements. Operating lease in the books of lessee, operating lease in the books of lessor, finance lease in the books of lessee, Finance lease in the books of lessor. Let's try to start with finance lease first. Accounting for leases, recognition and measurement. First one is a finance lease. Under finance lease, books of lessor, and what is the accounting in the books of lessee? Let's see now. First transaction, first recognition at inception. First recognition should be at the inception of lease. Think from a lessor's perspective. If it is a finance lease, the leased asset is transferred to the lessee. Along with the leased asset, I am also transferring substantial risk and rewards. Substantial risk and rewards incidental to the ownership of the leased asset is also going into lessee. There is something called a substance over form which we learn in accounting. So, even though in form lessor is the owner, in substance I'll treat lessee as the owner of the leased asset since he has acquired along with the leased asset its rights or its risk and rewards as well. So what I'll try to do is, I'll recognize the leased asset in the books of lessee. And I will de-recognize the asset. In the books of lessor. That is not sufficient. Because when I have to recognize the leased asset, there is a debit of leased asset. When I have to de-recognize the asset, I have to credit the asset. But there is one more part of entry pending. There is a debit in lessor pending and a credit in lessee pending. What we'll call here is recognize a lease receivable. I have to receive periodic lease payments from lessor. So I'm recognizing a lease receivable here. Here, I'm recognizing a leased asset. Along with that, I'll also recognize a lease liability. Because it is a liability for the lessee to pay the lease rentals to lessor, it is an asset for the lessor to receive the lease rental from the lessee. So I'll recognize the lease receivable as an asset, and in the books of lessee, I'll recognize the lease liability. So what is the entry in the books of lessor? Lease receivable account debit to asset. What is the entry in the books of lessee? Leased asset account debit to lease liability. This is recognition. Then what is the measurement? Measurement. Inception of lease. Lessor should always recognize it at NIL. What is NIL? NIL is present value of GIL. Lessor always recognizes the lease receivable at net investment of lease. Lessee will recognize at lower of fair value of the leased asset or present value of MLP from standpoint of lessee. Lessee's books, MLP always for the lessee. It is not nil, guys. It is net investment in lease. A net investment in lease is equal to present value of gross investment in lease. NIL is not nil. This is the initial recognition and measurement. Then let's go to the subsequent recognition and measurement. My subsequent recognition should be at the time of lease payments. It is received for a lessor, paid by the lessee. Every lease payment should be divided into principal plus interest. This should always be there. Because in both the cases I am recognizing it at present value. But lease payment is the original payment which is not at present value. So what we'll start doing, we'll start splitting it. We'll start splitting it like how we do for a hire purchase. Hire purchase, I'll recognize the hire purchase asset. Every installment is split into two parts, a principal and the interest portion. Same thing I'm trying to do even here. Now, give me the recognition part of it. The recognition will be in the books of lessor. My entry, lease receivable is debit. So now I have to reduce the receivable, so I have to credit it. So I will receive bank account debit. I am receiving the lease rental. 2. Lease receivable. I am crediting the receivable only to the extent of the principal portion. But what I receive is both interest as well as principal. So I have to credit one more that is called as finance income. Finance income is nothing but interest. This fellow, obviously it should be the reverse entry, I guess, because he is paying it, so to bank. Lease liability reduces, so debit lease liability. Instead of crediting lease receivable here, I'll debit the lease liability here. So write the entry, lease liability account debit. Again, lease liability is recorded at present value, so lease liability should be only debited for principal portion. Interest will be called as finance charges, which is the interest to bank. Now I hope you remember this part. This part was para 4D of A16. If you remember that, finance charges under finance lease was a definition of borrowing cost. Definition of borrowing cost given in para 4. We had 5 parts of that para 4. Under that para 4D, we discussed about finance charges under finance leases. So that finance charges is, we are connecting it here. So in the books of lessee, we get finance charges whenever we are talking about finance lease. Because finance lease, every installment is broken up into 2 parts, principal and interest. This interest can be considered as borrowing cost as per A16. Then who depreciates the asset? If you observe, in the first entry itself, I have de-recognized the asset here in the books of lessor. So I cannot depreciate in the books of lessor. Lessor books does not have the asset only. Who has the asset then? Lessee recorded the asset. He recognized the leased asset as well as the lease liability. So here I will record the entry as depreciation account debit to leased asset. This finance charges here is a nominal account. This finance charges here is a nominal account, along with the depreciation being a nominal account, which should be transferred to P&L. So at the end of the year, you can record the entries as finance income to P&L in the books of lessor. In the books of lessee, P&L account debit to finance charges to depreciation. Both the nominal accounts should be transferred to P&L. This entry should be at the end of the year. Even the depreciation as well. This is the recognition and measurement of finance lease. So let's talk about operating lease now.
So what about in the ending when the lease is transferred? You get some amount, no? Right.
Operating lease again in both books. Books of lessee as well as lessor. Not a complicated treatment, guys, when we are talking about operating lease, because there is no transfer of ownership at all. There is no transfer of substantial risk and rewards. So all this is not necessary. My only operating lease recognition will be on lease payment. On lease payments. Lessor, he will treat it as income over a straight line basis. On a straight line basis over the lease term. Lessee will treat it as an expense on a straight line basis over lease term. Simple treatment given.